Hey everybody, Preston Bryn here with our weekly roundup for the Trader User Group. This is for the trading week ending December the 9th, 2016. Man, oh man, oh man, have we had a really interesting market post U.S. presidential elections with Mr. Donald Trump, or I guess that would be Mr. President-elect Donald Trump. This post-election rally, we've added just about 7% to the value of all U.S. equities. And that comes to just slightly under $2 trillion, about 1.7 trillion roughly, based on the market's close this past Friday. Amazing, amazing run. So I guess that'll put some extra holiday cheer in everybody's holiday mood or festive mood for the end of the year, certainly for the folks that have money in the U.S. markets, or in the most markets, but generally the U.S. markets. But really, when you think about it, nothing's really changed. I mean, the new Congress here in the U.S. won't be seated until January 3rd, which is the first trading day of the new year. And the new president and vice president won't be sworn in until January 20. But as you guys know, markets move on expectations. They move on where the market price action thinks the markets are going to go. And based on the policies that the Trump administration have put out, has been right now extremely bullish for the U.S. markets. It's just extremely bullish. And that's what the markets are interpreting right now. We got to also keep in mind that we're starting to get a little bit stretched from an evaluation perspective. That right now the U.S. Markets, the S&P 500 is about 17.3 times projected profits. Profit margins are a little bit high. They're at decades high based on where we are right now. And we're going to be coming up into 2017 with probably a steeper yield curve for interest rates. Going to be fighting a little bit more tightening of labor wages here in the U.S., rising rates, as I said. And the currency is clearly going to be very volatile next year because we got a lot of other binary events coming up, elections all across Europe, which can set the euro in a tizzy, move the dollar a little bit higher. We also have a fear of, as the dollar gets stronger, then interest rates in the bond market and the debt market are going to be competing against the U.S. equities as far as where money should go. So it's going to prove to be very interesting. And for next week, the key obviously is the Janet Yellen, we call her AKA Aunt B. She's going to come out and put out her recipe for her blueberry pie for 2017, which most people believe she's a dovish individual, so it's going to be full of sugar and fat and sweets and all the things that markets love. There's almost 100%, just slightly under 97, 98% chance of a rate hike next year. So, but what everybody wants to hear is what's the trajectory for the following year, 2017. Now, the markets have already priced in a 2 rate hike year for next year. But if you guys remember last December, almost a year ago, the Feds came out with a rate hike and they had a 4 rate hike policy for 2016. And of course, we didn't get there. In fact, this would be our first rate hike for 2016. At the end of the year. So let's see how 2017 starts to unfold here. But this last week, in fact, we saw the S&P hit its 17th record close in this year. Unbelievable. The NASDAQ had 14 record closes this year, and the Russell, the small cap, it's had 13. And the Russell's come the furthest since the February 11th lows of 2016. So it's really been a really interesting year. And for 2017, for those of you that follow, 2017 is the Chinese year of the rooster. And I've heard it said from a couple of folks that it's an erratic bird with fat tails, according to Bank of America's, one of their analysts over there. I thought that was pretty funny. But it's going to be the year of the rooster. And B of A, BOFA, came out with their upside projection and their downside projection. Their upside projection can be up to 2,700, but their bearish case for 2017 is 1,600. So I would say that's a pretty damn big range, wouldn't you? I mean, hell, if anybody could put a range out like that, I mean, how the heck can you be wrong? Now, what you see on the screen here is the daily chart of the S&P 500 futures. We're having a really good finish to the year in our user group. And 2017, I think, is going to be even more exciting than 2016, if you can believe it. I've got a lot of indicators on my screen here, but let me just take everything off for just 1 second and just leave on here Fibonacci extensions off the previous pivot low. And we've come up, and like I said, when you start getting into dry powder, which is an area where we haven't been before, there's really no once we took out this area right here, there's really no area here over when you look to the left. Are there any price levels that we're going to serve as resistance points? There's not. But one of the best ways to look at potential stop points when you start getting into the dry powder up here is Fibonacci. And Fibonacci has a tool called Fibonacci extension that we use heavily here, not necessarily to trigger a trade, but to give us a general idea of where we're going to be. And you can see that our original Fibonacci extension that I had in since the springtime was right around the 2200 level. And it took us a while, but we made it. We hit it this year. I was calling for a hit in the fourth quarter of this year, and that's exactly what we did. We hit that level, and then we started to pull back a little bit. And then once we came back down here, and then the Trump election, boom, we came up. And I ran some Fibonacci again off the prior pivot highs and the pivot lows. And that put us right up in this area here. Common Fibonacci extension points here, or 2263 to 2283 in the S&P 500 E-mini futures. And the first stop-off point that we hit was this one here, which is a very common one, the 1.236 extension. So if I just take this off the screen here for 1 second and just kind of clear it up, and let's come down to a shorter time frame, you can see how these extensions off these key pivot points really are serving as a valuable tool for us to just say when can we expect some profit taking, some consolidation before we move higher. And you can see here we spent almost a few days. We spent a few days there, and then we got a breakout. We came back, we tested the area, and then boom, a move higher. Folks, that's a bullish move up because we came down, we did the retest, the requisite retest, and then off we went again. The next area is going to be 2263. Now remember, I've got buddies that have been short this market post-election that just have said, you know, the markets are going to go lower. Never mind, this is just a blow off top. On and on and on they go. And I can tell you guys that they may be right. But what we do is we follow the price action, no matter how illogical it may seem to be, and understand price action for what it is. It's a combination and a collective of fear and greed out in the market. It's not a logical thing. Over time, fundamentals will win out. But in a near-term basis, and remember, you can be in an overbought or an oversold condition for over a year on a longer-term chart. So you guys, you've got to understand that you've got to follow price action. You just have to. And I spent 3 months this, as I do every summer, over in Europe doing seminars, talking to some of my big hedge fund boys over there. And I'm participating in running with another gentleman a fund over in London, and I'm doing some things here in the U.S. And I can tell you right now that there's still a lot of money on the sidelines, but I believe we're probably going to wear out this up move here shortly. But again, you want to use the Fibonacci as extensions to kind of give us a gauge of where that can be. And you can see here the 138 and the 150, so 2263, 2283. And we are also in the seasonal period where the markets tend to be on the bull side also, primarily in the small cap. Small cap has been very strong. Now, when I put all of my other indicators on the screen, you can see this big wide blue area here, or I guess that's purple and blue. I don't know what color that is. That's been on our chart for quite some time. That was my original area of major support. And if we come back out to a weekly chart, for those of you that follow me, on the YouTube channel or in other areas, you can see I've had this up here going all the way back to the summer months, back when we were making this down move here. These big choppy moves right in that area there where we could not break out of this area here. Really a strong area right around the 2100 area. You can see I had it colored in. Once we came down up and did a retest and we started to move back up, I had this in here as a big possible resistance zone, but a potential area where we're going to go. And it gave us that nice Elliott wave 3, 4, 5. Now you can see an extension of the 5 here from my original Elliott wave 5 down here like this. But this is where we're going, and we hit it nicely. So now where to next? I do believe that we may see a little bit more of a bullish nature, just the momentum, but I think we're probably going to peter out a little bit and then get into a consolidation mode. And then there's going to slow down a little bit. I don't think we're going to have a reaction to the markets like we had last December when the Feds hiked the rates back in December of last year. I just don't see a reaction like that. But we're off to the races here, but we're also setting up for a longer term bearish divergence here as well. We've got a high right there, clearly a higher high right there. And if I just take everything off the screen here, let me just clean it up so you can see it a little bit better here. If I take everything off the screen except the fibs, you can see here we got a high and clearly a higher high here. We had a cross in the MACD here. We haven't had a cross here. So if we start to peter out and have just a little bit of a pullback, it's going to bend that line over, which is the trigger line, and then we could end up having something like that, which gives us a bearish divergence, which suggests we can come back down, probably test this prior peak breakout here, the 2193 area, probably expect some little bit of a test of that, which would obviously be the 2200 area, which would be a normal test. Now we're at 2254, so that would suggest a pullback of at least 50 to 60 E-mini handles. But we may see that over the next, let's say, 4 weeks. I would not be surprised to see that at all. It still does not take away from our bull market here. If I were to connect the trend lines like this and just draw that line up like that, that's the channel that we're in now on this weekly chart. So again, coming up to this area here, which would put us up to these upper boundaries here in the fib, and then pulling back to the channel, or pulling back to the bottom of this upsloping channel here. I didn't draw the lines very straight, but you guys get the idea. That's kind of where we're sitting right now. Okay, so that's what I'm looking at on the charts. If we look at the Russell, let's look at the Russell futures. If we look at the Russell futures, again, new highs here as we close the market. It moved up to 1392, almost 1400, right? Let me just take this off the screen here. Almost up to 1400. You can see the opening price of the rut, and it's just off of the and this is a weekly chart. This was the lows back in February of 936. Up to 1392. Folks, that is a huge run. I mean, just parabolic, right? It has been parabolic this year. And the reason why the small cap has been parabolic is because it's less affected by a stronger dollar, because most of the small cap and some mid cap, most of the sales and growth is contained within the borders of the U.S. Not like the Dow, which over 60% of the earnings are offshore, or the S&P, which is about 55% or so is offshore. So it's less affected by a stronger dollar. So you're seeing this here. The other thing that is really moving it is if President-elect Trump comes out with the less regulations like they're talking, we could see this have even more legs next year, because this is pent-up demand. That's what it is, and there's still a lot of money on the sidelines. So you can see this big move up here in the Russell. Now, and I've talked to our members about this, on a pair trade, perhaps going short the Russell and long the NASDAQ. Because if we look at the NASDAQ, and I'll pull out the NASDAQ 100 futures here, you can see it is also on a tear. But we haven't made new 2016 highs since last made in October. So we're still underneath here. And you can see at the NASDAQ bubble, the bubblicious back in 2000, the dot-com bubble, that's the former all-time highs at 48.84 for the NASDAQ futures. So we're at this bubblicious area here, which is going to serve is a tremendous amount of resistance in this area. Now remember, if you trade it on a daily basis, you can spike up and you can do these things. But on a longer term basis, we could spike up and then give it right back up and then end up back below the dot-com bubble highs, because these were here a long time ago. I mean, if we put it back on the weekly chart, and let me just show you where we've come. And you can see here like this. This was the dot-com bubble highs that were made back in 2000, March of 2000. And you can see we finally, from the move off the 2007, 2008, and we made the low, and then we started moving up on March of 2008, or actually from March 2002 up, down, and then boom, we've just started this long run higher. And we've actually exceeded the trajectory going back to 2014 for NASDAQ, and now we're back to these bubblicious highs. Trust me, folks, when you hit these kind of resistance points like this, where it is going to be very difficult to get the energy to get north of here. I think what would move us north, remember, all of this right now is on speculation of what could happen with a Trump administration, with less regulations, lower taxes, repatriation of money overseas, and I could go on and on and on. All this is on speculation. If a lot of this does not come to pass, or let's say it's watered down, we're going to give up a lot of this because we're already at high PE ratios right now. So I'm just giving you guys a heads up on what we're seeing here. If you were not in post-Trump election on a lot of these, now's not the time to be loading up on longs. It's not. Now, we've been in some of these longs right out of the post-Trump election, and we're riding them right now. We'll probably ride them through the end of the year. And in our secret trader, we've been having a really good time making some good money on some trades that we're running. And by the way, I'm going to be opening up our secret trader to non-trader user group members starting in January. So just be on the lookout for the email around that. It should be a lot of fun. We're going to have another great year on that one as well. So that's kind of where we're sitting. The other area I will point out is that we are very low in volatility. You can see these zones here. These zones are here for a reason, folks. And it goes along with our option strategies and what we do based on what zone we're playing in. Right now, our zone, our sandbox, is in the green area. And that is the comfort zone for the market, but it's also, you got to be very careful once we get down in this green area. Now, we can stay here for a while. You can look back, going back to 2014, how we were here for many months at a time. But we just have to trade a little bit different in our option strategies and some of the things that we're playing here. Okay, but that's kind of where we're sitting right now on this one. And then if we look over here, I had identified for our members about 25 or 30 different stocks that you want to be long in post-Trump election. And we've been playing in these, many of them with some ETFs and some commodities as well. And we're going to be revisiting these as we get through the inauguration and we see how things start to fly. Now, the other area that's just been really knocked down is the bond market. This is a daily chart of bonds. We've given it all up. We're at a key level right now. Let me just clean up the chart so you can see through all this mess. I've left key fib levels on the screen here, but let's focus on this right here. This is a key level. I'm going to come all the way across the screen, and I'm just going to put it out there. Okay, that is a key level there. I think we may get a little bit of a break, and we may just move up a little bit right in this area here. And we may even form a counter trend foreleg before we come back down and break it again. But I think it's going to be, if you have not been short, and you can just well, let me just clean this up here. If you have not been short the bond market, now is not the time to get short. Look at that channel right there. I mean, we have just been riding that channel all the way down, and then we just broke it right here post-Trump election with all the policies that were coming up. I think we're going to work our way back inside this channel and then hang up a little bit before we give it back up and come back down again. But there are no divergences on here at all. I mean, it is going that direction here. So being short bonds, being long interest rates is where you want to be. Now, I've had everybody long interest rates in TBT, and you can see here on the TBT chart, this is a daily chart of TBT. It moves in the direction of interest rates. You can see here we were in this thing for a while, and you can see down in that area down here, right in here, I was saying, okay, let's get long TBT, and boom, we're off to the races. Again, if bonds do a counter trend move, we can expect a little bit of a counter here, but we're not coming back down here again, at least not in the near term. Okay, if anything, we're going to hold up here, maybe even go a little bit higher for a bit. So that's kind of where I'm looking at on the interest rate environment. Currencies, the dollar. There is going to be a point where interest rates are going to, which is in the debt market, is going to start to compete with the equity market for money. And it hadn't been a competition of late because interest rates are so low. Money is forced into the equity market, which forces up asset prices, creates higher PE ratios. But once interest rates start getting higher, you're going to see that competition for money between debt and equity. We still don't have it yet, all right? And even with the 25 basis point rate hike that we will see in all likelihood next Wednesday when Aunt B jumps to the podium, gives us her recipe for blueberry pie, well then here's what we're going to see. I think the US dollar is going to move up even higher. And then we're looking at, and let me put it on a weekly chart just to put this into perspective. The dollar, and let's just, you can see here on this chart right here, we're at a key area here. We're breaking out, in fact, of a key area. If I just draw this box right here, you can see that box. And we've been in it really since early 2015. We visited the top of the box, we visited the bottom, the top, the bottom, and now we're back on the top and we're looking to break out right here. That could be a nice little strong breakout with this interest rate hike. But then once the dollar gets up in this area here, interest rates are going to be higher in the US, and now debt's going to be competing with equity for where money goes. Okay, that's going to put downward pressure on US corporate earnings. It's going to put downward pressure on the equity market, and you know you got to think of the market like this. You've got the balance between equity over here and then debt over here, right? And you just got this debt and equity, and there is a balance. When equities are like this, generally debt is like this, and vice versa. But right in the center here is something that we call the central bank, and the central bank it can move over here, closer over here, and put the fulcrum more on equity, or it can move over here, put the fulcrum on debt, where debt goes down and equity goes up. And that's where it's been. And now this fulcrum is moving back more towards the center line, and that is going to cause a little bit more of a downward pressure on the equity market and the dollar as the dollar gets higher. So that's kind of what we're looking at here. But let me just really step it out here to show you where the dollar's been. Okay, so can it go higher? You betcha. Look at this. We're sitting right here, but we haven't seen dollars this high, guys, since 2003. That's 13 years, a decade plus 3 years. That's where the dollar is right now. Okay, and we're in an unusual situation where the U.S. is the only major market that is tightening and taking money out of the market via trying to get money off the balance sheet, trying to undo the stimulus that we've been doing for the past 8 years, where all the other countries, Japan, China, all across Europe, Great Britain, they're still doing their bond buying. In fact, last week, this week, Mario Draghi came out and said, yeah, we're going to extend buying the bonds and all this other stuff too. So it's going to create a dynamic where the dollar is going to get even stronger. Now that puts Aunt B, aka Janet Yellen, in a box, because she is going to have to raise rates because inflation's getting higher here, which is going to drive the dollar higher in comparable to other currencies, which is then going to start to hurt U.S. corporations. That's why our corporate profits. That's why next year is going to be it's going to still be the year of the currency. If you guys remember, in Q4 of 2015, I said 2016 is going to be the year of the currency. Well, I think that's going to continue into 2017. It's going to give us some wonderful trade opportunities. So that's kind of where we're sitting here. Let me just get this off here. That's where we're sitting here on the US dollar. And we've got some interesting things going on in the pound and the yen also. The yen is just off the table to the downside. So, and the yen goes opposite of the Nikkei. So we've got some interesting things that we're going to be looking at in 2017 for these. Now, if we come over and we look at gold, I get a lot of questions on gold. I have said I thought gold was going to hold. I knew gold was going down. I said 1200 looks like a common support point, but we've blown right through it. Now I'm calling for gold around the 1100 area. Remember, a stronger dollar is bearish gold. And you may say, yeah, well, Yellen raised the rates and the dollar started going up last December, but gold started going up. But that situation is different than the situation we're in now. Last time there was higher fear for more inflation. Here there is none. Inflation is very gradual. Globally, there is almost no inflation. That's why Draghi is extending stimulus, why they're having trouble in Japan and China with their own issues, debt burdened issues. So for us, with lower inflation and a stronger dollar, gold is still projected to go down, okay? So that's why in December of last year, coming into this year, when Yellen hiked the rate one time and gold went like that. Remember, we traded gold to the north in Q1 of last year, but I'm totally different right now. I'm more of a downside action for gold until we see signs that inflation is going to start to take hold. There is no divergences here. There's nothing on my chart that would indicate that gold is going to stop the downside action near term through the next 90 days. I believe, however, that at the end of 2017, gold is going to be higher than where it is now. But I think the downside action is we still have more to go. Energy, oil, we've been trading oil every month and we've been having a lot of fun in it. I've got a great trade that we use for oil and we're going to continue with that trade. We had OPEC meeting last week. We got a meeting now this weekend with non-OPEC producers. I think oil is probably going to go even higher near term. Longer term, oil is going to settle in, probably even come back a bit, okay? And you can see here with each new peak in oil from that price to this price to this price, I don't see any divergences on the MACD. In fact, it's flat. I could just draw a line across. There is no divergence. That means any pullback in oil is probably going to be bought near term. We've been trading this here, doing very well in and out of oil futures. We've been doing synthetics in the option market. It really works out nicely. And for those of you that are non-members, if you have the ability to trade options on futures, you get the equivalent of portfolio margining on options and futures, which is why we like it for non-portfolio margined accounts. And for those of you that may not know, portfolio margin is what you get on your account if you have over 125,000 in the account for Thinkorswim. Others, it may be a little bit more, a little bit less. But it's a great way to trade and hedge your portfolio a little bit by doing some things in the commodity market, because sometimes they run independent of the equity market. The agricultural market is still looking good for us. The meat market, we've been playing some in meats. We're holding feeder cattle now. The soft market, we're holding some shorts in the orange juice. So we're just having a good time as we go through the end of the year. We're going to be going flat the market the last week of the year, and we're going to be starting off fresh next year. I hope to see you guys in our secret trader, especially you non-members. You're going to be enjoying it. We're going to be making money as we always have been doing. in our group. So I will see you guys next weekend, and as we round out the year, we'll be kicking off the new year. Have a great weekend, folks, and I will see our members this Sunday night. Take care, everybody. Ciao.